this
Sweet.
last year, I've kind of gotten into yacht rock. We could have a whole yacht rock
You're
discussion until we go live fully across all of our platforms.
you 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 I can see that. Our generation, our
It's supposed to be
generation
like
is
you
there.
thought elevator music, but I'm like, it's more than that, right? Michael
Oh, it's
McDonald,
that's right.
Christopher Cross. I mean, there's actually some real guitar work going on there
Yeah, yeah,
sometimes.
yeah.
But anyway,
Yeah.
this is a yacht rock day because we're talking about Jerome Powell, who's soft, who was a softer uh in terms of his personality than Jerome Powell. I mean, he's a soft-spoken, gentle, not so giant, except for the balance sheet is giant.
Yeah, so when we're talking about this, and it looks like Tony's just jumping out of the main room, and we're going to be there too, and we should be live in YouTube now
Elsewhere.
and here. So it looks like we are going live everywhere. Um, maybe, maybe I'm still
We'll
not
just
seeing
we'll
it.
just pretend that we are live, right? I'm like
Yeah,
in all of our platforms. So it's just take a little bit of a. So for those that know, we're broadcasting live on YouTube. We have our own TheoLive channel, and then we have our main chat room. And so we're trying to get Tony off so we can go on. And it looks like we are just going live right now on that platform as well. So we are
all right.
officially live on every channel, Blake.
There we go. Now it's real. So we won't need to talk about yacht rock. We got 3 minutes until we could see the rate not change.
Right, 97% probability. I mean it's like, is there really going to be anything today not from the announcement? I don't believe, right? So if we look at the CME Fed watch here, we just scroll down, we look at just kind of refresh, virtually no probability of any rate cut today. 99.5% is going to stay the same. So this is not about the rate cut, it's about how Powell is digesting, how the Fed is digesting all the stuff that's going on from the White House.
Yeah. Whether he thinks that is he going to be strong armed into cutting rates. And my first answer is I think just for political capital, he is going to fight everything that Trump wants to do because they're not friends right now. But on the other side, he cut rates twice when he probably shouldn't have. So
Yeah.
why would he not be interested in cutting rates? It's kind of the problem with if the person you hate says the right thing, does that mean it's not the right thing?
Right. It's like a reverse Grinch scenario, right? You had a huge heart for the prior administration cutting rates, and now all of a sudden your heart's two sizes too small as we're considering it now. But obviously, we never thought interest rate cuts were right in the first place. But I never thought they should have raised as quickly as they did without reducing the size of their balance sheet
Right.
and trying to cure some of the ills. I mean, it's just been one mistake after another, right? I mean, he was talking out of both sides of his mouth, running over the main street in the front of the truck while spilling out money out of the back of the truck to the to those that have access to that money. And so again, it's been a very interesting, very just confusing policy, even for people like us that have watched it, and even former members of the Fed, as Warsh talked about. There's no policy guiding there's no historical policy guiding their measures they're taking. There's no standards. So
No,
this is again
any
another
of the
data
standards
point.
they've said isn't they don't haven't held to it.
Right. It's like
We want to keep this target rate. We want to keep this number. We want to keep the inflation this way. We want to keep the employment this way. And anytime they had to push past one side, they said, well, we're not looking at that. We're looking at this. And they
yeah.
jumped to the other side.
We're looking at the S right now. We're down about 0.5%, but you start to look at the SPX, and Don talked about it this morning. But here we are hours later, and right now the expected move has actually gone up. It was $37, is now $40. That's a big move. This is between now and the end of the session. So if you think we're to come and go quietly, the market's not suggesting that, and the fireworks may not be on the announcement. It may actually be on the press conference where he's going to have to address questions about tariffs and other policies regarding spending, layoffs, etc. And he's going to have to address questions about the economy. What is he really going to share in that amount of time?
Yeah. And I don't, how many times have you gone into 1984-esque doublespeak, where it's just, we're going to do this while we're doing this, which are completely conflicting data. So right now, the
Yeah.
market has seen the non-rate cut as exactly what we were pricing in. And so maybe we were trying to unwind the sitting still by pushing prices lower, and then we were trying to push it higher. Well, maybe they don't sit still, but the market has said, okay, that's enough. We've knocked it down. So now you're right. This comes down to the pressure. Is he going to be able to say anything that will really change the overall view of the economy and how easy the money is going to flow towards businesses?
I mean, the hard thing with
Stock
Powell is
market.
like, I mean, how is he going to articulate? So, for example, we have a new Treasury Secretary. Again, market guy, for example. What's he going to do with regards to Treasury issuance? We're still going to be running deficits, large deficits potentially, even though we're cutting spending, trying to at least. And also the idea, hey, he said, hey, we're going to raise tariffs 2.5% per month up to 20%. Hey, and you can negotiate it with us if you want. There's a lot of unknowns here. And again, is Powell just going to sit there and say, I don't know, and just deflect and just push stuff down the road? I don't know. Like, again, is him being quiet during his during the press conference going to unsettle the market? So the initial reaction slightly down, we're kind of reversing back up again. It's a non-starter right now, right?
Yeah, it's the big nothing burger volatility that we keep getting. It's getting the what do they call it? The burger from In-N-Out. I'm not a burger guy, so I can't remember this. The one that's just like everywhere. It's like almost soup because that's kind of what we got. We've been given a burger and it's just made a mess everywhere. But it's up, down, it's sideways. We're still looking to see what we're eating, but at this point, it's just splattered us and covered the counters and our jackets with grease. There's
Yeah.
just nothing there. And the response is what we would expect. We priced in no rate cut. We got no rate cut. And now the market's saying, okay, are you going to make us feel safer? And that's what we're going to now be waiting this 20, 30 minutes. But there's
We're
some
looking for
data
that.
that goes into this. Go ahead.
We're looking for that guarantee in a box, right?
Yeah.
Nice little guarantee, the guarantee fairy. If you guys have seen Tommy, you may know where I'm going.
I was
But
going to say, I know where you're
you
going
know,
with that.
Don's posting in chat saying, hey, as expected, but does not include language that inflation had made progress towards 2% goal. And that's gonna be hard to say. Again, tariffs, the 75 pass through, meaning that if you raise tariffs like 20%, if 75% of that gets passed through, we might be talking about rising inflation 1.4% this year. That's probably the worst case scenario. Best case scenario is we probably don't feel much of an effect at all, like 2018, 2019. We're going to fall somewhere in between. But the idea is that, again, how does the Fed again measure inflation at all and guide policy if we really have no idea how the policy ultimately is going to play out, how much of it's going to be implemented, and its a potential effect on inflation? We're dealing with relatively uncharted territory, which markets generally don't like. But right now, again, we're kind of holding on. We'll wait for the Powell testimony, or not testimony, but press conference.
The
We're
pressure is still going to
catering.
have a huge difference. But I would say your issue is as well is that we haven't made progress on inflation despite or because or not even paying attention to the tariffs.
Mhm.
We already saw that the number was going back up, whether we're talking about CPI or PPI. They can tell us that, oh, it wasn't that high, but it was actually higher than the previous month. We saw growth year over year. We
Yeah.
saw some expansion, and we would have seen a lot more if it weren't for the fact that oil prices pulled back off those highs. And so it is not nearly as controlled as the inference has been, and like you said, we haven't even dealt with any tariffs.
Right. And you look right here. I mean, again, we're now past the announcement.
Mhm.
We saw a little bit of uptick to $40 expected move. We're now down to 37, almost $38 expected move. Essentially, nobody's pricing in that this announcement was going to have any impact on the market. Everything's likely going to be at the Powell presser at the bottom of the hour, 12:30. What questions is he going to get? What fresh-faced reporter is going to ask him? Uh,
Yeah, the
I mean,
13-year-old.
it's just listening, and how Steve Leisman, he's been the CNBC Fed guy for years. He's getting grumpy in his old age. I want to see again. I'm not going to watch it per se, but I want to see how aggressive how salty is he going to be? Like Gran Torino is going to be like get off my lawn type situation in terms of Powell and Fed policy, or is he going to embrace the Trump admin Fed Powell, knowing it's going to be a difficult period of time to kind of figure out and digest things?
Yeah.
Small
And I,
caps getting smashed. Let's take a look.
yeah. And as we're looking at this, who benefits from rate cuts? Who benefits the most? It's going to be tech stocks and small caps. So we already should have expected that a non-rate change would be more detrimental to the small caps and tech stocks. And so it's all about whether we give any type of guidance. We wanted cheap money. That's according to, if you're a small cap, we wanted cheap money. We were hoping that you might surprise us, but you didn't give us cheap money. So the market is going to punish the leveraged tech companies and the small caps.
Yeah. So we're looking at the dollar right now. We're seeing the dollar is strengthening vis-a-vis the euro. That will, again, all things being equal, that would be negative for the market. If we're seeing if gold prices are weakening, that would also be indicative of a stronger dollar in real terms. So we're seeing since the announcement, the dollar strengthened in real and relative terms. Something we talked about on Friday was the Japanese yen versus the dollar. We did get a breakout to the downside. So if we look here, we're seeing that reverse as we speak. So we got the breakout here, bounce back up. We're recovering off our lows right now. So we're back into this range, a key level about 155, 154.90. But we're seeing some near-term strength in the dollar, even against the Japanese yen, which look, I mean, they raised rates. We're not lowering rates. We're not seeing that spread come in. So maybe a little bit of risk averted here if the yen were really strengthening substantially. That's the unwind of the carry trade, right? Playing out.
Yeah. Well, and after that many years, I think you have to unwind more than what we've done. So any
Yeah.
higher rates in the future, you can't assume that your zero interest rate to a 0.5% won't see more unwinding, just because we're talking about trillions and trillions of dollars over decades. So there'll probably be some more there as well.
So if we're seeing some weakness in the broader market, we're seeing technologies getting hit the most, went down 1.3%. If we're seeing that gold's weakening as well, we might assume that Bitcoin is also weakening in this scenario. So if we go to 1 day, 1 minute, again, no big moves yet, but again, a little bit of a fade from the high at 12 o'clock, pulling back here, but. There's been this kind of buzz about, oh, we're going to have a cryptocurrency national reserve. Obviously, Trump has said, hey, you can't do central bank digital currency in terms of the Fed. DJT, I think, is getting a little bit of play here because they're trying to jump into the this space, right? Debanking issues, et cetera. There's been the Trump coin, the Melania coin. I think you have a Barron coin. I understand that again from a debanking perspective, but what's the role right now? So we look at BTC. I mean, there's a lot of bulls out there thinking this is going to be a reserve opportunity. Is that really bullish for Bitcoin, Blake? What are your thoughts?
Well, I guess it depends on what you think the outcome is going to be, because I think simple supply and demand. We know we have theoretically limited supply. And I say theoretically because people that want to argue with me on this, they always say, well, they're only going to have X amount of Bitcoin mined, and then it's capped. And I say, who said that? Well, they did. Who's they? You can't answer that question, then you
Yeah.
can't really trust that. Okay, so
But
if you can't tell
you
me,
do have hard forks and you have soft forks, right? I'm like,
yeah,
we have a lot of soft
yeah,
forks from Bitcoin. Could you have a hard fork where they expand it? Sure, they could, right?
they could.
Could we
And the
suddenly
other
have a
side is,
big find of gold somewhere in the underground that we could pull out? Sure, we can, right?
yeah, yeah. And there's always that little tiny question of whether that's really true. But the fact is, demand is going to push it higher if people keep on buying it. And we know that BlackRock just increased to 2.7% of all Bitcoin out there. So that's certainly propping up demand while also taking supply out of the market. I think that's going to try to push it higher. But if you're asking the question whether going to a reserve currency is going to keep demand for Bitcoin high because it's going to reduce our debt, that is a completely different
Yeah.
question. And the answer is emphatically no, it will not reduce our risk. It will not reduce our debt. That's the most absurd logic I've ever heard in my life. It does not pay
I know.
off debt to buy assets.
And this was put out there by a member of Congress, right? If we buy 200,000 Bitcoin a year for the next 5 years, we'll be able to pay off our debt in 20. I'm like, wait, is it Bitcoin money or is it a productive like asset, like a commodity? Well, it's not. It's just it's pure money. There is no business except for those that may be making money by again providing that the power right behind it. The miners are doing the hashes and stuff, getting paid on that stuff. But the idea is that there is no opportunity. I remember talking with my wife's uncle. He was a hippie, still is. He's down South America, living the life, the hippie life. But he's like, but he's come around a little bit, it's because of life experience. But we were talking one time. He says, okay, Social Security, we need to put it in a bank and they'll pay us like 5% interest on it. And I'm like, that kind of very simplistic thinking, right? Well, you're gonna put trillions and trillions and trillions of dollars in the bank. How's the bank gonna make 5%? Right? I'm like, there's a lot of problems there. But that's the problem with, again, this idea of Bitcoin reserve somehow being a very bullish case scenario for Bitcoin. Maybe it helps it kind of gravitate towards its intrinsic value as far as its role in our economy as money, but not so much in terms there's no investment opportunity in Bitcoin because there is no business. It's just a limited fractional, this ability to break it into it just pure money, almost like gold. It's like gold. And what investment opportunities are in gold? None. In fact, it's negative yield over the long term. And
And
so
that's the
again,
same kind of thing. It's just avoiding inflation risk.
right.
Gold is an investment to avoid inflation risk unless you're trading leverage. It is just putting money from one asset to the next. So imagine if you would borrowing $500,000 to buy an asset, a house, and saying, there, I paid off my debt. If you don't make payments on the debt, you have the debt. Just because you used your debt to buy an asset does not mean you pay off the debt. If you can say, I'm going to take 500,000, buy a house worth 500,000, because that's what the Bitcoin is worth, its dollar amount. And then I'm say, and next year I'm going to buy another house for 500,000 and I'm going to do that. And if the real estate market keeps going higher, I'll pay off my debt. No, you won't, because you're just going to keep adding debt and owning an asset unless that asset increases at a leveraged rate faster than your debt is increasing. And then you sell the asset without collapsing the market, you do not pay off that debt.
Here's a novel thought. Again, there is some short-term inflation implications of this, but how about we just end the Fed? Okay, just get rid of them.
I'm listening.
Cancel the debt they own. The dollar goes to zero, and we just say, look, we're not going to tax cryptocurrency. We're not going to tax gold. You can use whatever currency you want. We're in a great position right now to be able to use any currency for transactions given technology. And go figure, we eliminate the dollar entirely because its value is going to go to virtually nothing. And we just say, look, we'll transact in whatever you want. You can do it already anyway. We're just going to expedite it. And we'll say, well, again, the dollar will diminish, but we'll convert it to other currencies and other forms of money. And we just let you decide what you want to use. How about that?
Okay, let's do it. I'm in.
Brandon's planning to compete in the Thunderdome. Yeah. I mean,
up?
I'm not one for debt cancellation if you're going to maintain the Fed, but you cancel the debt if we're basically saying, c'est la vie, dollar.
Yeah, it's if you cancel the debt, you crush the dollar, because if you cancel the debt, you make our debt worthless, and therefore everything that is backed by it is worthless. The question is, what does that do to the global demand of our goods and services? What are we willing to accept? Well, go look at Venezuela, go look at Argentina, go look at any of these countries that have a currency collapse, and you say, what do? They stopped taking the bolivar and started taking dollars. They stopped taking the bolivar. And in fact, I was talking to a driver when we were in Florida 2 years ago. And what he did is he would send prepaid debit Visa cards, or would load a prepaid debit Visa card, because it sat in cash to his family in US dollars. And so he didn't care. His family were living like royalty because the bolivar was getting weaker and weaker and weaker. And every day it's like they were being given millions of bolivar as the money got weaker and weaker, because they were all in a stronger currency. All you have to do is determine, like you said, which currency do you want?
Right. I mean, again, I'm not expecting that. I'm not even sure that's necessarily going to be the best out. But the idea is like, okay, if you're going to go extreme, maybe that works. But the reality is, if we just free up our ability to then replace the dollar with something else and you do it incrementally, right? But again, the US government holding a reserve of Bitcoin is not this massive bull case scenario for Bitcoin. It only may allow it to achieve a degree of utility in our society, which may help improve the price a little bit, but it's not an investment. Ripple XRP would be more of an investment. There's an actual business. There may be returns from that business.
Yeah, that's kind of
But
my feelings about Ethereum, because at least, even if it's not the coin, at least there is a negotiation that they do use their blockchain for business.
Right, right. So again, there are returns. So again, the idea of allowing and freeing stuff up in the financial industry, I love the idea back in 17, 18 of companies being able to, if you have an idea, I have this kind of talk with my brother on Friday, the idea of how people leverage China. I know you did a little bit in terms of
Hmm.
importing stuff. The idea is if I have
Import,
an
export.
idea, I can go find a manufacturer. They'll make it for me, even in relatively limited quantities. Hopefully the quality is okay, but it allowed access to production that historically we haven't had. But the idea of, again, freeing up the cryptocurrency markets to gain access to capital, there were businesses that would have traditionally gone to the stock market, issuing shares of stock, very expensive, very like, tightly held process. Whereas in the cryptocurrency market, you can get, if you have a great idea, people want it, you can get access to capital quickly and efficiently. You can use the Ethereum blockchain, you can issue your own tokens and all that stuff. And it provided you financing for a business that may or may not be successful, but
Hmm.
it allowed people to gain access to capital versus the current system. Again, it's kind of like back in the day, if you want to manufacture something, you got to go to Westinghouse or GE, sell your idea to them, sell your product to them, your designs to them, and that was your return. But
Yeah.
so I love the idea of democratizing, decentralizing everything as much as we can, but as a process.
But is that dead though? Is the decentralization of crypto dead now?
Well, I don't know. Again, it's all function of policy. If we allow people to use it without penalizing them, that's why I don't really like the idea of companies like Coinbase. Now you hear the idea of the rumblings of many financials, banks potentially getting into cryptocurrency. What's the relevancy of Coinbase at that point? Is JP Morgan going to do Coinbase as a crypto as a custody, right? To be able to custody that stuff better than Coinbase? Probably. Are they
Yeah,
going to
I was
have
going
the
to say,
technology to
pretty
more
easy answer.
efficiently convert stuff? Probably. And so yeah, I mean, I think Coinbase, who I've always felt they're a leech on the system anyway, actually advocating for regulation back in 18. So I think, again, as we democratize a little bit more and more offerings in terms of custodying assets, crypto assets, obviously banks will kind of take a little bit bigger role there.
Yeah, well, and we've already seen things like you can buy crypto directly from your PayPal account, and PayPal is a regulated entity.
Yeah.
So you're seeing it move over to Venmo and Cash App and Zelle, and everybody's going to now be reporting. They're regulated entities. They're going to be reporting 1099s. So they're already set up to do the same thing. And I think all of them have a better infrastructure than Coinbase does. So I think it's probably true. We'll probably see that same thing go.
And
Um,
despite Coinbase getting upgraded today, they're not really got to pop and then drop here. Again, we're now testing intraday lows in Coinbase. And, so again, I really think, again, as we're thinking about the uncertainty of policy, the uncertainty of the effects of policy, not just Fed policy, but federal government policy, what's the trickle down to state policies? Are we really cutting spending? Government spending has been a source of inflation and growth from a GDP perspective.
mhm.
So as we think about some of the fundamentals, I mean, so Blake, what's your take right now in terms of the state of the economy? If we look over the various announcements over the last month here.
Well, then that's one of the things we're talking about. No rate cut today, but I'm kind of throwing back to the previous ones. We cut rates because we were focused more on employment, because we certainly didn't have inflation under control, and we're getting closer to our target, but we never reached the target, and we turned that back around. So I think the Fed has been watching closer to see how is employment doing and everything that's going on. And if you look at these numbers, if you just look at the reports, I mean, you can just quickly scan and see there's a lot of red. There's a lot of red, and I think you have just inflation and employment data here, right? Or no, you have growth here too.
All the
All US.
highest impact announcements, right? We could
Okay.
add it. We could
Yeah.
add to what we
Oh,
want.
you're
So we're
fine.
just going.
No, you're fine. It's all good. It's just the highest impact. Okay. And So I was just looking at things and said, yeah, we had more job openings, but that didn't translate into more jobs. We had more unemployment. We had missed numbers on the ADP. We had missed revised lower in the previous on the non-farm payroll. So we haven't had a solid positive economic data really in the entire month. The econ has had so many misses. Consumer confidence down, employment down, higher unemployment, new unemployment claims, services sliding, revisions down. And even on anything that did beat, we had revisions in the previous month. So that makes you have to question, if we had a beat this time but revised down last time, did we really have good data? Did we really have good information?
It's like when you go to Kohl's. I don't like Kohl's because they're markup to mark down. You get your Kohl's cash. Oh, we're 50% off. We have this artificially high price, so we're marking down 50%. So the idea being is you feel like you're getting a value. But in this case, if we mark down the prior number and this is the current level, then we're going to make it look better, right? As we see that month over month change, makes you feel good. We're going up, makes it feel good. Like go to Kohl's and getting a discount when you're really not compared to other stores anyway. So
yeah, you're absolutely not getting anything better. And if we're not revising the other numbers lower, then it would be a different story. But JOLTS is the only thing that really had a positive and a positive. I mean, I was going through all the information, and it's the only one that actually had positive. But what do we know about job openings? The job opening labor turnover survey, it's fine to have the job openings, but that's we were at 11 and a half, almost 12 million job openings. And so to climb higher to 8, yay. It's still lower highs, lower lows. Trend. Yeah.
So we're beating in a very negative direction, right?
Yeah, we pulled back aggressively, and now we're right in the levels that we were pre-COVID lockdown. But did we really hire 3 million more people, 4 million more people because we had 4 million more jobs? No. They're called phantom job postings. They can post job openings with no intention of filling it because they also got benefits by posting jobs because it looked like they were hiring and retaining employees to get their ERP. So this is not a good number. It's the only one that does look like it's good, but it's not a good number. Employment doesn't look like it's that positive. And I don't know if you've looked at it recently, but if you looked at the Warren tracker or any of the data as far as on layoffs, 6.9 million employees laid off from Amazon, Google, Meta, Microsoft in the last 20, 30 years, right? But as we're looking at that, we want to say, okay, that's fine that we can run those numbers. In the end, what are we seeing now? Yeah. And if you look at California and Texas and New York, there's big, hubs for a lot of employees and big companies. We're announcing a lot more layoffs, and we're doing a lot more layoffs in the last year. 2024 was not a great year, and it's still getting worse. And I still don't think we've adjusted for the missing million people that we claimed had been hired.
Yeah, and we have a new administration with people coming in that are going to report maybe differently. So the idea is, we may start to see an unwind of some of the growth we've experienced, and at a minimum, we're talking about potentially significant cuts in discretionary spending. We're talking about lower employment numbers from the federal government, which has been a source of job growth for the economy. And so, we got tariffs. That's not going to necessarily change the deck in terms of our trade deficits. So as a result, we could see a near-term hit to GDP, whether or not we're really potentially getting better or not. The numbers are probably going to slant more negative here shortly, right? As we start to see some of these short-run impact of just cutting back on government spending, which has been a source of growth. And inflation. Now, again, the hope on terms of the inflation story is certainly largely depending on some of these policies playing out well for the economy generally. I guess if you fire 2 million people, you export a bunch of people, send them back to wherever they're from, maybe. Mm-hmm. Again, we can like it or not like it. It doesn't matter. There's going to be some impact on the types of numbers we're looking at here.
Yeah, and the deportation. Everybody wants to act like, and I'm not afraid of controversy, but I'm also don't believe I think most people are wrong because most people sit on the edges. Deportation, to follow the laws, Great, I don't have a problem with that. Deportation because you don't want immigrants is a problem. It really hurts the economy. And there's so much data on that. It is not an argued point amongst economists. And the other side of it is these big farms. Do you think, and I'm talking about farmland primarily, the big ones, do you think that they were willing to risk having all their employees be undocumented immigrants?
And there are so Stephen Miller talked about this on a show. I saw a snippet from it, but he addressed the idea that 1% of our population, the migrant population, works in agriculture. The program's still there, right? So they can still bring people in for agriculture, but I don't know. I'm like,
Legally
I'm
on
more of
visas
a
and other things, you're not going to be deporting
right,
those people. And the fact
right,
is, these farms are smart enough that if they suddenly had their entire staff and crew deported, it would crush them. They're not idiots.
right.
They know that they have to do it the right way so that they can actually keep business going. So
Yeah.
this is we already have a lot of this, and the deportation is going to have an impact on costs, labor costs. Labor costs will go up. That's inflationary, but it's not going to be as dramatic as you think.
Yeah. I agree. And a lot of
I'm
it,
an
I mean,
economist,
it's a
Jay
very
Bush.
automated type of technology. I mean, the zapping weeds. I'm like, so again, there's depending on the size of the farm. We have some smaller farms here, like, and they'll have a lot of manual labor coming in. So again, it depends. But I do like the idea of, look, we're changing things. We're trying to cut costs. We're trying to cut spending, which I really like from a federal level. Ultimately, that may help us long term. But again, just realize there's going to be volatility, and that's what Blake and I are addressing. There's going to be volatility in these numbers specifically. And again, if the Fed is if they're data dependent, the data, what is it? I'm like, and what is its impact beyond just the short term to the medium and long term? And
Yeah,
so
you
again,
keep
this
saying
is
data dependent, and then whatever number doesn't fit with what you're going to already do, you change your mind on which data you're going to focus on.
right, which is what they've done. But we could see some big shifts in numbers. And again, how are you going to interpret it? Are you just throwing it out, or So again, we're going to have to see. I mean, again, what's Powell's response to these types of questions and the potential volatility? So let's look at the SPX. Let's see what the expected move is right now. Again, we're about to get it about 34 and a half points right now. So we've only dropped about 5 points since just prior to the announcement. And again, so all of the volatility is priced in right now. This is not encompassing Meta's earnings that's after the close, and Microsoft earnings that are after the close
Mhm.
today, right? This is
This is
by the
just
end of today. And the only driver right now is Powell and his mouth.
now someone just said that Powell's talking the market down. He is not. He hasn't started talking yet.
No, he hasn't.
So it is not this last 30 minutes, the market repushing the lows has nothing to do with Powell talking. It's speculating of what he might say, but
Right.
it is not him actually talking. And so we haven't got there yet. It's not there. He's coming out on
People.
stage in about 2 to 3 minutes.
Yeah.
And then we can see what he says and we can watch it as it happens. But it is not him talking it down yet.
Yeah.
That's not saying he won't. I'm saying
Right.
not
And
yet though.
like I said, I mean, when the big kind of changes in the announcement was just reflecting inflation, and makes sense they're going to leave it out because who knows, right? I mean, again, this is a point where the future is not exactly clear. I think there's a lot of things that people may be encouraged by, but we haven't yet seen the rubber hit the road in terms of actual function, right? In terms of actually moving profitability, right? Shifting production, other things that the long range goals might be. And to accomplish that in 4 years might be optimistic if the next administration comes in and just wholesale changes it. So
Right.
we'll see. But Nvidia, I mean, this to me is very reflective of kind of where we're at though. Again, I really think that I kind of shared this going into the end of last year is that we need to shift how we think about the market. If you're about diamond hands and hodl and crypto bros and all these meme kind of themes and meme stocks that have no earnings, no cash flows, this is probably not the market for you. If those are the kinds of things that are your primary focus as a trader, yes, there'll be opportunities in some of those names, but to me, this breakout just represents a big shift. And when you see these kinds of breakouts in Nvidia, it's usually about a 60% decline from the peak. And so we had it in
Yeah.
18, we had it in 21, Focus on what? Oh, we're never going to go down because cryptocurrency, right? They got to build all these chips for miners. 2021, oh, chip shortage. Now it's AI. It's just the next theme, but this has tremendous, risk to the business in the near term. So could we see 64? Yes, we could.
Yeah, and the gap down, right? I like the channel up at the top, by the way. I know it's a little side note, but
Yeah.
yeah, the channel up at the top. I like the breakout and the retest. That's a beautiful retest. So the question is does it continue to play that $20 range? Because you certainly haven't hit 110 yet, and I think 110 is your easy target. And the rate cut, I don't think it has as much impact on Nvidia because they are not necessarily a big leveraged borrower, but I do think it still comes down to DeepSeek and the idea that quantum computing doesn't necessarily need the same processor
Yeah.
units.
And the
So
reality for Nvidia, I mean, again, this just kind of speaks to its business, is that a lot of its growth was about financing people that didn't have money to buy their chips in the first place,
they are the
but they wanted to
CarMax of
create data
chips.
centers, compute, and so they took a loan from Nvidia to get a loan from the bank to buy more processors. And so a lot of their growth is through these types of channels. And what we did find from DeepSeek, potentially they got access to processors they shouldn't have had. Then you obviously realize, their sales in Singapore went from about 500 million to about 7 billion. How much of that is circling back to China through back doors or Saudi Arabia? There's a lot of stuff going on here that creates risk in the near term. And again, this is absent anything that's going on with regards to the Fed itself. These are just, again, right now, we're just starting to turn our attention to risk and real growth and valuation. And that's the big story right now.
Well, and he just came out, he's on the stage, and the first thing he says, the economy is strong, pardon me, is strong overall.
What does that mean? I'm qualifying the economy as strong.
That's hilarious to me. That
So
is
there's a lot of
hilarious.
weakness, but overall strong.
This economy is strong. Pardon me. He actually corrected himself
I know. It's like,
mid-sentence. Is strong overall.
I know. Yeah. And focus on achieving our dual day goals and maximum employment stable prices. Of course, we're giving lip service to that. But yeah, again, it's a Powellism, right? It's just he has to just stick his foot in the mouth. That good isn't enough. So let's turn our attention to yes. So we're looking at as we're kind of seeing how things are changing as he's talking, and we're waiting for something. But apparently, the market liked that qualified economy a strong comment. We're up right now.
Yeah, we're recovering. Nasdaq's recovered 75 points off the low. Not that big of a deal, but um, considering it's been down a couple
I
hundred,
love
but
Kevin's comment. He says, and the market loves it overall.
overall. Well, and it is totally. It reminds me of the "You Sir Are Not Bobby Kennedy," right? I knew Bobby Kennedy. You sir are not Bobby Kennedy. Um, it reminds me of that. You sir are not Alan Greenspan. You don't have the ability to wordsmith. You cannot wordsmith your way into monetary policy. You don't have that skill set. You step all over your own words and make mistakes all the time. But he tries to, and he has never stopped trying to. The
Yeah.
fact is that he say, even when he's talking about, I'm just reading the closed caption as it's happening. So the labor market conditions remain the weakness in the middle of last year. The activity in the housing sector seems to have stabilized. Did it stabilize or not? So lots of qualifying words in this one. If the
Yeah.
labor market conditions remain, it would. Payroll jobs gained 170,000 per month. And anyway, so he's going through it, but there's tons of qualifiers in this, and more so than I remember even last time.
Yeah.
It,
And
it
again, I
shouldn't
think
be, it seems. It did or it didn't. Did the numbers
right.
report that it supported a stable housing sector or no?
But this goes back to, I mean, is his hesitation reflective of the fact that he's having trouble viewing into the future, right? What is his real take on the policies being pursued? I'm sure we'll have more questions on that response on that on those topics. But again, if he's not feeling good about going forward, and again, this is no indictment on the policies. This is just one person's potential opinion that they're
Mhm.
trying to draw from here. Again, is some of the qualifications based on it looks okay now, but again, I love the idea of cutting spending and all that kind of stuff, but the idea is short run, all the stuff that they're looking at, it's going to hurt short run
Mhm.
for short-term pain, long-term gain, right? So even if you like the policy, there is some short run effect on actual data that's very dependent on the largesse of the federal government. So we're moving
Yeah,
towards a sustainable 2%.
I just saw a purple tie and mixed body language. He looks tired to me.
Yeah.
Tireder.
Look, Bernanke, the issue with Powell is that I'm like, it's just this kind of hesitant. Bernanke wasn't so much that way, but the guy was like, I'm like, what he came out of his mouth was just ridiculous. But
Yeah. Well,
again,
I
it
can't
just
make
maybe didn't
oil.
sound as ridiculous.
When we hit peak oil, and his comment was, "I can't make oil." Okay.
Right.
Did anyone say you could? We're
Right.
asking what you're doing with the money.
Right. And again,
How are
oil is
you?
a big part of the inflation story. Obviously there was the question posed to the new forget another the mouthpiece of the president, I forget, asking about egg prices. Well, a lot of stuff goes into that. Ask JD Vance about prices in general. It's like, well, oil is a big part of it.
It is.
Um,
It's like I always say, when you can't do core inflation, because that only shows you what you're not using in transportation directly, not transportation to secondarily, not cost of getting the eggs to the store, not cost of running equipment and machinery, not
mhm.
costs of plastics. All of those use oil. So
Yeah.
core doesn't tell the story. So
But again, as
oil
we
is too
think about
important.
inflation, this is a distinction that Powell's raised in the past. There's a difference between policy creating inflation and actual monetary type of inflation. And
Mhm.
so if we think egg prices are going up, maybe it's a consequence of again, slaughtering chickens that may or may not have been affected.
Yeah,
So
it's
that will raise egg prices, right? So
non-discretionary slaughtering of chickens. I don't know. It
right.
seems a little bit excessive.
But again, that should raise egg prices as we have fewer chickens. And so the idea is that what's the Fed going to do about the price of a chicken, right? Or an egg, if that's the policy. If we're not gonna expand production of oil, and we can do it productively and cheaply, how are they going to impact the price of oil other than if the dollar were to strengthen? But again, the inflation story would force them to kind of raise rates, but again, that's not really something they can solve by virtue of monetary policy.
So he just came out right now. He just came out and talked to someone, asked him point blank about what Trump is asking him to do with demanding interest rates drop. He said,
Yeah.
the question said, I guess it's a three-part question. Has the president done this to you? Has he made the demand? Secondly, what's your response to that? And third, what effect will the president making that demand have on policy? And Chair Powell says, three questions I see is really one question, though, and said, I'm not going to have a response to it. It would not be appropriate for me to do so. Complete and total dodge.
Well, whether he said it directly or he said it through the media, right? It was said.
Yeah.
It's out there,
Yeah. Yep.
right? So how do you reel that back in? Again, all I can say is we're just independent. We're going to engage. We're going to be data dependent. We're going to just do our own thing. But well, obviously clearly we know. I remember back in the financial crisis, 2008, Fed raised rates, oil prices went to 140, right? And
Mm-hmm.
Barney Frank was saying, "Look, we're going to remove you, right, if you don't cut rates." So there's always been this kind of implied or direct kind of
You're
statement by the federal
independent, but I
government to
can
the
fire
Fed to
you.
shape policy. It's always been that way.
Yep. And of course, every president wants
Wants
cheap
lower
money
rates.
because it makes them look good.
Absolutely. Yeah.
Yep. So it's interesting. It kind of goes back to what you and I were talking about before. If the person you hate makes a statement that you can't disagree with, the statement's true, does it make it less true because the person you hate said it?
Yeah.
And so he can have as much conflict with the president as he wants. He can say that he's independent and not going to do anything that the president says, and it's inappropriate for him to comment on it. But the fact is, he's already shown that he's willing to cut rates when he shouldn't, when inflation is still hot and detrimentally. And so, why would this be an issue to him? He's going to look for whatever data he can to completely roll up the drop rates, fix the fact that they raise rates too fast. And if employment's too slow, he's got to get there. And he's actually talking about moving toward the 2% inflation again. So he's not assuming that they made progress as much as they have in the past. He says we're seeing it move towards it. But they were kind of doing the whole mission accomplished, and now they're
Mhm.
saying we're still seeing progress moving towards it. We're not there. The
Yeah.
data doesn't show that, but the market likes it.
We're liking it right now. Again, I mean, there's really been nothing in terms of like, something that's really going to scare people, right? We're not being extraordinarily hawkish. Again, we're still seeing 30 points on the board here with, again, about an hour and 20 minutes left. So it's come off slightly, but not a lot. Again,
Mhm.
everyone's just kind of waiting. Where is there going to be a shoe that drops in here? So at the end of the day, I mean, I think let's say, for example, let's say the status quo remains, right? Powell does nothing to really change the market's outlook. If we look at where the market is right now, are we really looking at a market that's probably in terms of probabilities edging higher? Or do you think the downside is still relatively high at this point in terms of think probabilities of up versus down, let's say 50 points or sorry, not sorry, 500 points rather.
I was going to say 50 points.
Yeah, so let's go 5%. So let's say, here's what about 250 points up or 250 points down.
If my take is much higher probability of 250
63.
points down,
That's kind of where I'm at. So we got
much higher. I'd say
6,300 or
2 to 1.
5,800.
Yeah. I'd
So
say
if we're
2 to
thinking
1 that
about
we go down
probabilities of
first.
here versus there, again, I still think the downside was that something material happened this week. We
Mhm.
can't just shrug off what happened with Nvidia and the entire technology space. That was again really hit hard. Again, Apple downgraded today. I mean, these are not small things, and we have earnings announcements coming up now. If the announcements come out, surprise the upside, the outlook's amazing, yada yada. Okay, maybe that's the scenario. But I mean, Apple again. I mean, we got a little of a blip here because of the DeepSeek news, and maybe Apple doesn't have to spend as much on infrastructure and that sort of stuff, or maybe it's just a matter of they were more oversold, but they're going to
Mhm.
come up tomorrow after the market. But again, we're seeing some real weakness, and my theme coming this year was I think the Mag 7. Again, the growth there is going to be more limited, which is going to place more pressure on the S&P. I do think there's a chance if the economy holds up, the small caps may have a chance to hold up well here. But still, if we see a recessionary pressures, then small caps are going to see a correction too.
Let's take a math approach to that, just from the perspective of what percent are the Mag 7 of the entire market?
Over 30%.
Over 30%. How do you move 30% of the economy off of 7 stocks up another 10%?
Yeah.
You're talking about trillions of dollars. And that probability is mathematically so complex to lift the entire global economy off of 7 companies that are limited to the same set of demands in the global economy as far as technology goes. To move a 35% of the total value up 10% next year, 15%, like we've seen in the past, is mathematically very low probability.
Yeah.
And the pullback and correction when something is overpriced, it is very easy to see money leave that area and go elsewhere, and to see it go off the peak. That's easy. Pulling money out of that and seeing it drop that 5% is easy, I think.
Yeah. I mean, when you think about multiples, I mean, this is XLK, but we take, just the Mag 7 stocks as being very representative of what we see here.
Mhm.
But the Mag 7 back here in 2020, for example, reached a high of over the P of 30, and that P cut, dropped to 20 here on that pullback. I mean, think about this for a second. I mean, if we see these stocks that are trading around a 30p again, similar to other peaks we've seen in the past, and I don't think that number is cyclically adjusted, but even 2022, we see a pullback towards that level. If we see just some sort of like just going back to average, we're talking what, at least a 20% decline from our peak at 240, which, that gets you down here below 200, right?
Mhm.
If we see a retracement back to, let's say, a third, right? Going back to a 20p, that's assuming earnings are exactly the same. We just go back to historical kind of norms or kind of pick good valuation points. I mean, that's a 33% decline. So we're talking what, about 750 off the highs. Now we're down here closer to that level. And that's just, like a 2020 or a 2022. We're not talking about a 2008, right? Or
Yeah, and
2000.
I'm really not predicting a 2008 here. I don't think we're as in a precarious as a position as far as a debt is concerned.
Yeah.
Um, and I don't see the housing market over leveraged the same way. I don't see 5.5% interest rates as crushing the housing market. It Unless we default on debt, I don't see that. If we default on debt, yeah, 60, 70% again, absolutely.
Yeah.
But
But again, back to 170, back to like 190, 180,
mhm,
190-ish. I mean, that would only be just pretty typical. We've had these, right? A couple of times just in the last 5 years. So again, as we think about again, we've pushed the valuations. If there's any sort of like kind of paradigm shift, just even slightly, again, just starting to trade back to normal valuations would certainly kind of emphasize the downside right now, downside
yeah,
risk generally. It's not to say there aren't areas that are strong, you know, there are stocks that aren't strong, right? Again, I was looking at, we're not tariffing China right now. And Baba down here off the lows is one of my undervalued stocks as my bet on China. This is up over 20%. AI news came out, overvaluation, stock price goes up a lot. When you see overvalued stocks, and I saw that with my Monday session on some of the tariffs as well, some of them were trading at overvaluations. The news really slammed the stocks, and other ones it didn't. And so again, valuation is going to be more of a story, I believe, in this coming year as a consideration for, hey, what's viable.
yeah. And I've been shifting, as you know, for the last quarter, last 5 months actually, more and more to valuation. That's what I talk about on Tuesday because I agree with you. It's
Yeah,
about how can they support their debt? What does this look like if things do get tight or difficult? Who are the best valuations? Not who. We're not going to chase glitter. We're going to chase strength
yeah,
and stability. And that's what I think 2025 is the year to chase stability. And that's my opinion, but I see that coming out in the numbers and what we're seeing now. So even with the Nasdaq recovering 200 points off the low, right now we just 200 points off the low.
mhm,
We're not even to zero for the day on the futures.
yeah.
So
I
this recovery is it's still a nothing burger.
And here's the thing: is I mean, someone mentioned I don't see the doom and gloom. A pullback to 1500 would not be doom and gloom, right? I mean,
No,
that would
not at
be
all.
historically pretty reasonable, right? So again, it's just one of those situations is that the thought process that we can just do this forever is unreal unless the dollar just is sinking into the abyss. But the reality is any resurgence in the dollar value, other factors, we could readily see a move back to 5100. And so I look at volatility markets pretty, extensively and consistently. And we had a signal back here, 5 to 10% correction. We got a 5% correction on the high. 5% correction here. We had the same signal on the 24th. We got a 5% correction. And so the idea is we had a very similar scenario kind of materialize the end of last week. So I'm looking again, base case is 5 to 10% downside. But again, a correction of 5,100 would be what? 20%. And those are
Yeah.
not non-routine type scenarios for every several years to see that sort of pullback.
And as far as not seeing the doom and gloom, I'm just talking about health of economies. And one of the other things that both Brandon and I talked about last week is I had zero bearish trades on last Friday's live. And it's just a matter of choosing which ones are going to give you the safest, best return on your risk. So this is not
Uh-huh.
doom and gloom. It's economic correction. It's reevaluating. It's rotation out of the Mag 7 into defensive positions, into value-based investing, into dividend aristocrats, into utilities and staples and healthcare. That is not an issue of doom and gloom. It's reevaluating, reassessing, and readjusting your exposure to the ones that are going to give you growth while safe.
Yeah.
That's so
And
that's not doom and gloom at all. If
yeah,
that comes
my
across as doom and gloom, I'm not expressing myself the right way.
my take is just the cheese has moved. So find the cheese, right?
Yep.
Mark asked about what about passive investing, buy every month, price no matter. Look, I mean, dollar cost averaging has benefits. I mean, I remember having clients back in the 2000 tech bubble and dollar cost averaging during that period. And it worked out okay. But let's just talk generally speaking, has the S&P 500 outperformed inflation since 1997? The answer is no,
Show
right?
us.
The purchasing power of the S&P 500's actually declined. The S&P's underperformed gold, right? So again, in terms of real returns, you're not buying any more house today with your S&P 500 shares. In fact, you're buying less home today than you did in 1997 in our neighborhoods in Utah. So ultimately, passive investing has been a failure. And as far as the timing, dollar cost averaging can help that a little bit. But the problem is, when are you retiring? So again, when are you going to draw from these accounts? Again, if you're drawing at the wrong time, it could be a really difficult road to hoe, especially when you're not generating a real return for 20, 30 years.
Yeah, and Andy says retire. Ha 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 ha
Yeah.
ha. You're not counting on your Social Security check there, Andy. As you know, kind of when we're looking at this, the defensive plays, where do I see the defensive plays? On the long-term, Florida Woody, I would say that it's still going into defensive sector as in consumer staples, healthcare, and utilities. They are the ones that have had evaluations. They're the ones that have outperformed today. They're the ones that have dividends generally that pay out well. And can gain even on down years, if you want to call the net S&P 500 down years, the rotation still puts money into those places, and they can gain 3 to 5% on markets that are down 10 to 15%. And so the net difference in avoiding the drawdown is that you end up being up 20% more than the rest of the market. But that doesn't mean anything, because if your account's not growing, right? It doesn't mean anything that hey, if I lost 10% and the rest of the market lost 20, I'm better. Yeah, you lost less blood in that last attack, but I want to see you protected and making a dividend, even if the market doesn't move in those areas, getting 3 to 5% dividends in while the market corrects down 15, 20, 30% and gives you opportunities to buy back in. And what you will see, it's why I go to the capital side under the numbers, not just the advanced decline, is if you see that money rotate out, a small rotation away from the mega caps into other stocks will put a ton of money into those, increase the demand in the smaller stocks. So yeah, under index watch, if you put in, say, just do the S&P 100, not the 500, if you wouldn't
I'm
mind.
going here. Personal, I'm going to
Even this is the 100. So what we're talking about is today, you can say, hey, we have more 59 stocks advancing, 42 declining of the 101, because Google's counted twice. But we have 59 versus 42. That would theoretically mean bullish. But we have 2.6 million in selling and 700 million, 2.6 thousand, so 2.6 billion, sorry,
billion, yeah.
versus 740 million in buying. That's selling.
Right. Absolutely.
That's
Don
absolutely
Harris on
selling.
slam today. I mean, and that's the thing is that I'm like, you just look at what's happening, and today is a bearish day for all intents and purposes, and we start to extrapolate that to the market. And again, we're just looking at price, but we're missing, right, what's happening right behind the scenes. Oh, we recovered. We got a long shadow here, but again, what are we doing? We had a great day yesterday, and this is virtually, it's an inside day. So I'm using Powell language here, virtually. No, it is an inside day, definitively. And so again, after you bounce, you get a pause day like this, you frequently get a reversal. And it's not 100%, but we're definitely lost the mo that we saw yesterday off that dead cat bounce.
Yeah, and I'm just watching him comment again. This is the kind of words I think could have some impact. And we're talking, it's that significantly predicting on more progress in inflation with labor market statement. Do you think this case now? He said, he's saying that the 12-month inflation is below 2%. They're already below their target. No, they're not. There's zero data that shows we're below 2%.
Yeah.
He says, remember, we are under 2%, but our goal is 2%. I don't know if he's getting his lines crossed and thinking he's talking about growth, but the fact is we are not below 2%.
No.
We're
Yeah. I mean,
closer
and
to,
again, what are the near-term effects of policy to change it or make it better and make it worse before it gets better, right? Just
yep.
by virtue of the numbers, right? And I don't know what Powell's take is on tariffs. Again, the thought that we're going to raise tariffs every month by 2.5%, and I like the idea of the broad idea of a tariff, but the max of 20%, I don't know what that looks like, right? In terms of inflation impact. Oh, you can negotiate with this to reduce it. So there's a lot of unknowns. Whether you like it or not, doesn't matter. It's just the idea we're dealing with a lot of unknowns, uncertainty. Market doesn't necessarily is not necessarily liking, does not going to necessarily going to like that, right? So expect to see more volatility. And so just think about from a trading perspective, if we're going to see more volatility, more of a two-way market, what are two-way strategies? In-out spreads or or is a two-way strategy, right? Those weekly, just borrowing Don's strategies, butterflies is a two-way type strategy. And Blake, you'll sell stuff to buy stuff. It's a two-way strategy. But
Yep,
the
all the
idea
time.
of just saying, hey, I'm going to buy highly volatile stocks with no cash flow and invest in stock and think they're going to go up 1,000% every time, that dynamic, and again, I've talked about a number of these trades just in the last few months, just when they're starting to peak, those are going to be more difficult. Those are the ones that where if the S&P is down 8, the Nasdaq's down 13, you might be down 40 or 50%. That's not where you want to be.
Yeah. And we've only got about 4 minutes before we got to pass the baton. And I like the comments that you need to pay attention, be careful with food companies because there's still stuff that could happen with Make America Healthy again under RFK Jr. And I would say whatever happens there, just like tariffs, regulation is inflationary.
Yeah.
It's going to cost them more to make your Fruit Loops when they take out the red dye,
Now
or
you
they're
read
going to
those
sell
things
less.
on say, oh, they export our US beef and import, foreign beef, and it's not as good. Maybe some of that stuff might change, but that
Yeah,
means less profits for companies maybe like Hormel, for example. But again,
yeah.
both a stock that we're both relatively bullish on, So, it's just, again, it's just one of those things where we don't know the full impact, right? It takes just time to let things work out, but we can look for trends. We can apply strategies that allow us to not put everything at risk all the time. And that's the stuff that I tend to focus on and just try to find, okay, where's the cheese this week? I'll tell
Yeah.
you, completely changed from last week to this week just by virtue of that DeepSeek announcement. So expect
Well,
to see that kind of edginess of the market. That doesn't lend itself to just the market just grinding forever higher.
and Brandon, is using the "who moved my cheese" analogy there. Something to keep in mind. It's the same thing I talked about twice now. Is that it doesn't matter who says it, even if you hate that person, and hate's a strong word. If what they say is true, then it's true. Same thing here. It doesn't matter who moved it. If the
Right.
cheese moved, go find the cheese.
Right.
That's the whole point of the book. So it doesn't matter what caused this, whether you hate Powell or love Powell, or you hate Trump or love Trump, or don't like the left, don't like the right, whether you want regulation to go one way or the other. The fact is, when the cheese moves, just go find the cheese.
Yeah.
And what we're doing is we're saying, hey, this is when we're seeing valuations come back and play. And certainly with the Fed decision to not cut rates and make money flow at cheaper, it does come down to valuations again. I still think that's your real opportunity. Defensive plays, find the valuations, and that's your opportunity, not just today, but for weeks and months to come potentially. And
The
you
thing
can
is,
see it right in the chart.
that's why I just hate the idea of like defining everything as bull and bear markets because ultimately that just papers over a lot of potential analysis you should be doing, right? So it's
Mhm.
like, my directional bias changes frequently, right? Just because of what I see in the volatility markets. But the idea is just to say, okay, I'm going to buy here because, oh, we're in a bull market. Well, what's a bear market? Let's start there, figure that out first, and then decide whether you're in a bull market or not.
Yep.
Bullish trends don't necessarily make bull markets. Bearish trends don't necessarily make bear markets, right? There's qualitative and quantitative aspects of it, but again, just the overall sentiment. We're gonna be launching a daily newsletter coming out here shortly that I'll be writing. And that's gonna be one of my daily focuses is just helping frame the market and the idea that again, it's not just bull market, so just buy all the time for years just be a little more granular in terms of your analysis, and that might help you consider more some of these other things we're talking about.
And last little comment. Someone asked him about how far we are from this neutral stance where we're balanced and we're supposed to be, and what he thinks the rate will be. And he says you can't know with any precision, which I agree with, but it still makes it sound like he doesn't know what he's doing. And then he said, so I think it's 4.3%. So he's already inferring rate cuts in the future. I don't see it being priced in yet, but we'll see.
Yeah.
He's talking about 100 basis points right there.
So we've seen the expected move for day about halved, half hour into his press conference. So Again, there may still be some last minute moves before we finish the day. Then that'll close and we'll have zero move by the end of the day. But just, hey, we still got 20 points of potential movement priced in right now between now and an hour from now. So,
All right. And Brandon, I'll be back at it live Friday together, and at regular room and main room and futures room tomorrow as well. So thanks for joining us. We're going to pass the ball to Corey in the main room. Thanks to all of you that are joining us from outside of TheoTrade on YouTube and our TheoTrade live channel. We appreciate you being here. Hopefully it was beneficial and you can see some of the moves in the market and what could help you. Brandon, parting words.
just, again, just keep some powder dry right now. Again, just have cash. Looked at, I talked about going to the highs here, looking to take profits, right? Hedging a little bit. I think we're still under that regime right now where the downside is still real. And so just, keep some powder dry here, right? Look to take some profits if you got some good gains and just have a little higher cash levels because we may have a much better opportunity on the upside or downside to be able to enter and get more long.
There you go. All right. Thanks, everybody. Have a fantastic remainder of your day. We'll see you tomorrow.
See you, folks. Thank you.